You are listening to Keystone's Stock Talk Show, episode 269. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again this week. I will start with our star of the week, Argan Inc., symbol AGX on the New York Stock Exchange, a stock which has been in our buy recommendation coverage dating back to March of this year. The cash-rich business, which provides a full range of construction and related services to the power industry, saw its share price surge 33% on very strong Q2 numbers. The stock has doubled in 2024. In our Your Stock, Our Take segment, Aaron answers a viewer question on Northland Power, symbol NPI on the TSX, a global power producer established in 1987, focused on advancing the clean energy transition by generating electricity from renewable sources. The viewer noted that the company recently reported what looked to be strong financial results, but the stock price keeps trending lower. Aaron lets you know his take on the stock, which pays a just under 6% dividend. Finally, Brett takes a viewer question on D2L Inc., symbol DTOL on the TSX, a provider of online educational platform through a single cloud platform. The company has a strong balance sheet and solid historical revenue growth. And while its stock has performed fairly decent in 2024, it remains below its initial IPO. Brett lets you know why and how the current fundamentals stack up. All right, let's get to the show. My co-host, Mr. Aaron Dunn, is here, and one half of the Killer Bees, Brett, is here. Brennan is in the bush somewhere in Saskatchewan, and I can only assume he's on mooseback at present. That's the way I picture him right now. Or either that or fighting a bear, or his father, which he says happens at times. So his dad's listening, saying, "Get that off there." Oh, I'm kidding. Fighting as in
his dad does listen weekly, like you should.
Oh no. Yeah, no, he's they were on a family vacation, so I'm sure they're having a great time. And we know his dad.
Well, we are going to see Brennan back next week, right?
You never know.
You never
Depends
know.
on how his bear fighting has gone and
right.
Moose back, right?
Yeah. Takes a while.
Or if he was, or if his dad
Moose back.
If his dad beat him at golf, we know that he may be too humiliated to even show his face on a show, right?
So. I don't know. Brennan's used to that. He's used to the humiliation. So he's been having to deal with us for years now.
It's true. That is tough. All right. Well, we finished off our 10X stock webinars last week. You can still get those on demand. We're going to post them as well to be purchased on demand, but you can still get the one last session on demand on our website, www.keystocks.com. But we had great turnout. So obviously people like the content, which is very surprising, of course, to us. But they seem to like it. We had great attendance over what was a summer period, which is great to see. So this week, Aaron, we will be going to the Toronto Money Show. So we'll put a link below when we send this out to if you're in the Toronto area or want to fly in from anywhere around the world, which I'm sure most of you do. We'll be speaking. I am speaking, I believe, on the Friday, and then the Saturday morning I do a panel, and Aaron is speaking on Saturday. 4:30 around then Saturday. I'm doing 4:15, I think, on Friday. So if you're in the Toronto area,
on
you
Saturday
listen to the podcast.
Speaking, right?
Yeah. I'm Friday and Saturday. Aaron's Saturday.
See, normally it's just both of us speak, but we share a 45-minute slot. This year we're getting one 45-minute slot for each of us, plus you have your panel. So it's more than twice as much of us.
They love us so
this
much.
Year, right?
Yeah,
that's the reason why.
True. Or they knew we might fight on stage, so they split us up, right?
That's like after last year, right?
Yeah, when we got into it.
They learned their lesson.
Yeah, that'll never happen again. But it should be a good, and we look forward to the money show every year. So if you're looking to
Mhm.
attend, we'll be there to talk, and we'd love to
If
talk to
anybody
you
wants to
before or
actually
after
come
those.
see us face to face and ask us any questions, that would be the place to do it. If you're from
In
around the
that area.
Toronto area,
Yeah,
or we'll be there.
we'll be there. All right, let's get to the poll question. It was an interesting one. Brett, you've got it. You're going to pull that up.
Yeah, so over the last week, we saw quite volatile markets. It was, I think, the biggest decrease in the S&P for, I think it was the last couple years now. So we asked what do you tend to do in these volatile markets? So 46% of our viewers said hold my positions and wait for the market to recover, classic buy and hold. 2% said rebalance before portfolio by moving to safer assets. 40% say buy more during the market dips, so buy the dip. And then 12% increase cash or cash-like assets to mitigate the risk. So I think that's a bit indicative of what we really say is you should be a buy and hold investor in the long term. If you're willing to buy a company, you should be looking not just a few weeks or a few months in advance. You should be looking a few years to be able to hold it. So, and the market always does, of course, go up and down over time, regardless of how great a company is. So you should be, at least to a point, be willing to hold on to a bit of volatility.
Yeah, and
Yeah,
I'd say, Aaron,
go
did you
ahead.
want to go?
No, you go.
Okay, I was going to say from our research perspective, we always have a monitor list ongoing, and there's some companies that we want to buy, and we say if they come on sale, then we may buy. So it was a volatile week last week. A couple of companies that maybe we might want to initiate a position in, starting to come closer to range. So that kind of it sounds counterintuitive, but we can kind of get a little more excited when the markets have a drop because you can see a potential buying point. But it's not like anything, even though there was a negative market, anything we're looking at just absolutely went on sale over the past week. But if you saw a continued downturn, that would be a time where we'd prefer buying versus when you see the markets just going on a rip, as I think Brennan would say.
Yeah, I mean, you can't avoid volatility in the stock market.
No.
We will talk to people that will ask, well, how can I invest in the stock market, benefit from the growth, but then avoid all risk and volatility? And the answer
We
is
do get questions
you
or
can't.
statements
Long
like that.
term, you manage the risk and avoid it through
Mhm.
research and investing in solid companies that are in strong markets and growing and profitable. But in the short term, everything's going to fluctuate. But those fluctuations can also be your friend. I mean, if you're in a situation where the market pulls back, 10%, but the fundamentals of some stocks are great, although they pulled back with the market, that's your opportunity often to jump into some of these stocks. Or they might be down 15 to 20%. It could potentially be an even better opportunity. Now, of course, we don't buy things just because they're down. Sometimes stocks pull back, or even markets pull back because they should, because they were overpriced to begin with, or there's some other issue. But there are always opportunities where solid companies are trading at value, and those opportunities are often available when the market pulls back.
So if we do see a further pullback in the market, we may get a little more excited, and clients may see a couple more buy recommendations over the next month. Now, that may or may not occur. You can find bargains in an up market as well, but
Mm-hmm.
you tend to, if we saw a 20% decline across the board in the market tomorrow, barring what the condition was that led to that, but in most cases, there'd probably be some really good companies that we want to buy today that we think are either efficiently priced or slightly overpriced that would come on sale, and that would be a time that we would buy. It is funny. Stocks are into it. People think of them differently from anything else. Like if you're looking at a car or a pair of shoes and you're wanting to buy that, if it goes 30% off, you're running out to buy that right at that moment. Stocks, particularly because people are so myopically focused on the near term, something goes 20% down, if the overall market did that, people panic more than buying. And if you look long term, those are the best times to buy. Now you got to consider the unique situation. If there was, a pandemic and then an airline stock went down 20%, it's probably in the near term going to suffer, and it might have more of a drop, right? So if those are again, unique conditions that I just put out there. But, you have to look individually at what led to a drop. But overall, if it's a good business that has a good future ahead of it on a drop, it's likely the time to buy.
Yeah, and I'll just add a bit more onto that. Like the pandemic is just a perfect example of really examining the causation and then does it apply to the company. So we saw it was a very aggressive sell-off even compared to like 2008. It was very sharp over a month and a half.
Short period of time.
Yeah, very short period for around 30% drop, depending on what index you're looking at. And if you were able during that time to properly identify what companies were really actually inhibited, so like stuff like airlines at the time that were actually going to get hurt versus effectively most other things, that was a great buying opportunity versus something like this where it's a 5% pullback. That's very different than a 30% pullback over a month.
Yeah, a 5% is a natural occurrence, happens all the time. If you start to see, 10, 15, 20, you start to get in correction, and 20 plus, you're looking at, by definition, a bear market condition. So, we'll continue to monitor. Many people are monitoring jobs reports in Canada and the US. We'll continue to monitor those. But really, our focus is on the individual businesses and what they can do over the next 1, 2, 5, and 10 years. And if we see a good company that comes on sale that is trading below its historical valuations, we could look to buy. All right, let's get into the meat of the show. I'm going to look at our star of the week, which actually comes from our coverage and relatively recent. We don't always share recent, but the company had tremendous gains and I'll let you know why it's our star of the week. So the company I'm going to look at as our star of the week is Argan Inc., symbol AGX on the New York Stock Exchange, trades around $94.65, $1.27 billion market cap, does pay a dividend and has been growing that dividend. What does Argan do? They're primarily a construction firm involved in power industry services. 75% of the business is there. About 24% of the business is industrial construction. There's a small percentage, 2.5% in telecommunications. The company provides a full range of engineering, procurement, construction, commissioning, maintenance, project development, and technical consulting services to the power generation market. Their offerings focus on engineering, procurement, and construction of natural gas-fired power plants and renewable energy facilities. So why has the stock surged 34% in the past couple of days, and why has it doubled in 2024? The jump in the past couple of days was produced by what we call a blowout quarter in terms of earnings. You can see the headlines here. Argan's EPS of 131 beat by 34 cents, and revenue of 227 beat by 35.95 million. So the company smashed analyst consensus earnings estimates and easily beat the most optimistic street estimates on revenues. This drove the stock up over the last couple of days. The year-to-date gains are really just a continuation of this trend. It's just been going on throughout the course of this year. Positive outlook in the quarterly conference calls from management, and a backlog, which we'll touch on in a second, that is moving to record levels from significant contract wins. So let's take a closer look at those numbers that led to the jump this past week. These are the Q2 earnings snapshot here. Revenues growth was up 61%, earnings up 39%. Gross margins were lower, which is something we are monitoring, but this is largely due to a changing project mix in the quarter and will fluctuate with differing projects over time. And it's, again, something we monitor. Let's look at the 6-month snapshot here. Again, shows you a continuation of the growth that from Q1, and it even accelerated into Q2 in terms of the top line. So let's take a look at the key. Well, first we're going to look at the balance sheet here quickly. Sorry. Strong balance sheet, which is what we like to see. One of the elements that really has attracted us to this business is, this is a more volatile business than we traditionally recommend, given its contract-driven nature of its work. So that strong balance sheet that continues to strengthen kind of gives you a little bit of a cushion here. Huge cash balance relative to the market cap. Even with the surge in the market value of the company over the course of this year, it's still 38% of the market cap is in cash with limited debt. We like to use net liquidity as a better view of the actual or excess cash for Argan, but this is still very strong at about 200, just under 260 million. Okay, well, let's look at that backlog. Argan closed the second quarter with a backlog of roughly $1 billion, which reflects an increase from the last quarter of approximately 210 million. 570 million are in renewable projects. Now, commenting on the backlog and outlook, management stated that the addition of high energy demand data centers, the onshoring of manufacturing operations, and the expansion of electric vehicle use are primary drivers for increasing forecasts of future electrical power demands and the robust pipeline of new opportunities that Argan sees. Argan's pipeline remains strong, and the company is confident that its energy agnostic capabilities and proven success leave the business well positioned to compete effectively for a growing number of projects coming to market. Now, we're going to look at the valuations quickly on the business here. I highlighted the 2024 forward P or 2025, forward PE. It may come down given the increase in the backlog, and that's probably on an earnings estimates that go higher in the near term and even into next year based on that earnings beat, like I said, and on the increase in backlog, which should increase earnings in future periods. So quickly, our conclusion here. Clients will be updated on this stock over the next week. But the 33% gain in the last 2 days, the 100% gain year to date, make Argan our star of the week.
And it's an interesting company. I mean, one of the things that we noted when we were doing our research on it is that it is a very contract-based company, right, yes. Ryan? So, yeah. There can be fluctuation historically in the financial performance, but it also had a huge net cash balance when we recommended it. So, we knew that there was, opportunity to make more dividend payments, potentially invest in some other internal growth projects as well.
Yeah, it gives you, it limits. These businesses can be highly volatile. So, you can have a business collapse if they have a significant net debt position and they're servicing a ton of debt and the projects dry up in the near term. Like, these businesses can have ebbs and flows in business. So if you're going to hold a stock like this that has higher than average degree of volatility, make sure the wind is at your back. And we saw those three things driving the business. You want that wind at your back in terms of business going forward, and then you want that solid balance sheet. And if they can be profitable, then you can have a significant jump. And Argan has worked out tremendously well in terms of what it's done over the course of this year. And with the growing backlog, that strengthens the opinion going forward into next year. And if they can continue to grow that backlog, it does say that, and management has stated this, and they stated this when we originally invested them, or recommended them, that the business had a very strong pipeline, and they're delivering on that because you saw backlog increase significantly in the last quarter. They have these large projects they're bidding on right now, so we could see a continued backlog increase, which would be great to see in this business. That's going to lead to higher profitability over the long term, as long as they can execute on those contracts. They have in the past had a few contracts where the execution was sometimes not all their fault, but if it's poor, then your margins are down. So you have to watch. It's not good enough just to have the backlog. Got to execute it on it profitably. Costs have to be kept in control. We're seeing them do that, and that's why you see a jump in the share price over the course of this year. And the valuations right now still aren't terribly unreasonable, particularly when you factor in that very, very strong balance sheet.
Yeah, just on the backlogs, the reason why it's so important to see conversions is in many management, they like to inflate it, and it's questionable always at first until you have that track record. So even if they say they have, let's say, 100 million backlog or something like that, if they're only getting really 10, 20 million of that, it's not a useful backlog in that sense. And you will see that occasionally, maybe not to that degree. but it is something which you need to be cautious of, and you need to see that track record, especially when it comes to backlog, because you need to see conversions, how much, because it really depends on the contract nature of the business too. Are these actually just customers saying, hey, we want this 5 years from now and there's no contract, or is it they've already signed it? And it's very big differences in backlog, so you can never really compare one companies, even in the same industry, backlog to another. That's why you like to see that conversion.
Yeah, you like to see management deliver on that backlog. And then there's teams that talk about pipeline and the size of the market, and investors sometimes conflate those two things. And if it is a signed contract backlog, you still have risk in that, but it's certainly better than a pipeline or what we're bidding on or the market size that we're looking at. And then, like Brett says, they have to execute on that over time and actually produce out of their backlog. And if they're losing 40% of their backlog every year that they've quoted, you can't take that backlog to be a good solid number that you can do any modeling off and forecasting going forward. Okay, let's move on. Aaron's got a question from Your Stock, Our Take segment on Northland Power NPI on the TSX. You've looked at Northland in the past several times, Aaron.
Yes, we've looked at Northland. I mean, we've been following Northland for several years, actually. So happy to take a look at this question for our listener here. This is Neil from Calgary. He's asking, what will it take for Northland Power to start moving the company as a global renewable power company, and reported what looked like strong financial results, yet the stock price keeps trending lower? All right, well, let's take a look at what is going on with Northland Power. First, what does the company do? They're a global power producer established in 1987. They have a focus on renewable clean energy and the energy transition. They have a stock price right now of $20 per share, about a $5 billion market cap, and a yield of just under 6%. The symbol of the company is NPI on the Toronto Stock Exchange. So looking at their operations, they do have a global footprint. This includes offshore and onshore renewable power facilities, as well as a smaller portion of their portfolio focused on natural gas power generation. So operations in North America, in Europe, in Colombia, and in Taiwan. And looking at the stock price over the last month, not really much to get excited about here, just a lot of volatility. The stock price up and down, trending between about $20 and $25. But if we look over the last 5 years, we can see that it's been pretty much a consistent downward trend for the stock price since 2022, 2021. Now, there was a period in the late 2020, early 2021, where there is a high level of optimism for renewable power stocks. I'd say I wouldn't go as far as to say there was a big boom in the space. It was fairly short-lived, but renewable power was very popular at the time. And since then, for the renewable power producers, we really haven't seen any of the companies produce much in terms of good performance. And that's certainly been the case with Northland Power here, trending down fairly consistently for the past couple of years. And then also a lot of volatility along the way as well. But let's take a look at these Q2 results because the listener did mention that these results actually look pretty good. So Q2 2024 financial results, sales were up 12%. Adjusted EBITDA was up 15%, 15.5% actually. And then adjusted free cash flow per share was 27 cents, up 8% year over year. So these are fairly good results at face value. And the question is, what is buried in these results that the market is seeing, that investors are seeing, that cause the market to not be very optimistic about Northland, at least in the near term, and why the share price has performed so poorly. So we'll take a look at some of the factors that were influencing the Q2 2024 results. There was higher wind resource for their offshore wind production facilities. That contributed an extra $20 million to revenue. Now, one of the things about renewable power, particularly hydro and wind, is that their financial performance is going to fluctuate from year to year and season to season based on just the wind or the water resource. So in some periods, it's going to be higher, in some lower. That will often affect financial performance because it affects production. And generally over a period of a couple of years, this is all going to even out. So higher wind resource is not necessarily something that we would see as like a recurring area of growth, unless it's the result of, they're getting more production because they're adding on more facilities. That's not the case here. So this is just short-term cyclicality in the wind resource, so to speak. Another thing was the commercial operation of New York onshore wind power projects. This happened in October in 2023. So this contributed in 2024 compared to the previous year. Now, this is something that we would consider to be ongoing contributor to financial performance and growth. There were the EBSA contributions for Northland's EBSA utility due to higher market demand. Again, this is probably just short-term volatility in demand, so not necessarily a function of an increased capacity, although there is some increased pricing in there. But then also very important was the sale of their solar facility, La Lucha. So this actually added $20 million to the adjusted free cash flow figure, contributing to the higher free cash flow for the quarter. Now, this is a one-time gain. Typically I would say this is not something that I would want to see in adjusted free cash flow. So I would take it out of free cash flow. And if you do that, Northland's free cash flow is actually lower in Q2 2024, significantly lower than it was in the same period last year. Now, the company has provided guidance for the full year. They are expecting adjusted free cash flow to be in the range of 130 to 150 per share. Now, they are saying that they're likely to hit the high end of that guidance. Maybe they even surpass it, but they did not change their guidance after Q2. So this is not a situation where they had strong numbers that exceeded expectations, and those positive fundamentals are necessarily going to continue. In fact, if you look at the guidance compared to what they produced in the first two quarters of the year, they would only be expecting 15 cents to 35 cents in adjusted free cash flow per share for the entire second half of the year. So this is certainly, they may exceed their guidance, but at the same time, this isn't a situation where the Q2 results have really improved the outlook for the year, or at least based on what management is saying. And then if we look at valuation based on the $1.50, so assuming they hit the high end, they're trading at 14 times free cash flow. I would say that that's a pretty decent valuation long term, although we also have to consider the lack of growth. Now, speaking of growth, one of the most important metrics we would look at for Northland would be the free cash flow per share, adjusted free cash flow per share. This is really a good representation of the economic value being generated for the common shareholders. So if we look at the company's financial performance on adjusted free cash flow per share going back to 2019, we can see there's really been no sustained growth. It kind of just bounced around between 2019 and 2023. And now in 2024, based on guidance, they're actually expecting a fairly significant decline compared to the previous year. So our take on Northland Power, it is, we like the idea of a globally diversified renewable power stock. It does have a long-term outlook for growth, meaning that they do have a pipeline of projects which they're putting into operation over the next 5 years. And they're expecting about 7 to 10% compound annual growth in adjusted EBITDA from those projects. So that's not cash flow per share. That's just adjusted EBITDA. Valuation is reasonably attractive relative to its historic range. If we go back previous to 5 years ago, it was trading at a much higher valuation for most of its history. But weak financial performance in recent years, particularly, even though the Q2 results looked good, they're actually expecting lower results for the year. They have been impacted by inflation, by higher interest rates. This has been a big weight on the company, but really no consistency in cash flow or dividend growth. So not been a consistent grower of the dividend. And then, in terms of just cash flow growth, even before interest rates went up, cash flow just kind of bounced around in a range. There wasn't really an established trend of growth there. So our conclusion is that we're continuing to monitor the stock, but the lack of consistency in financial performance and growth really keeps us on the sidelines. And there's no near-term intention of recommending Northland right now.
Yeah, it's interesting, but like you said, in the near term, if they're even though they're trading below historical multiples, if the near term trend is them to move lower in terms of earnings, it may not be a company that. I mean, we want to see, yes, reasonable valuations, but we want to see growth at least over the next year, 2, 3, 4, 5 in terms of earnings. Maybe you can look 3, 4, 5 years out and forecast growth for Northlands. But again, the forecasts right now don't include that over the next year to 2 years, as I understand. Correct, Aaron?
Yeah, I mean it's the forecast. Their forecast for growth, again, adjusted EBITDA, not cash flow per share. That's I believe this is about a 5-year forecast, probably, as these projects come online. But really, the metric again that we're looking at most closely is that cash flow per share. And what I want to see is an established trend in growth, in cash flow per share, and I also want to see the dividend growing as well, and that's not something that Northland has been providing.
Yeah, and like the reason why for Northland's a perfect example of why we look at per share metrics is they issued a significant amount of shares when their stock price was high, which is most likely the right thing to do. But you see this across utilities where at times they will issue a significant amount of shares to take on new projects. It's a capital intensive business, utilities as a whole. So you expect them to do that. But that's why you need to look at the per share metrics is, are those actually accretive on a per share basis? Because at the end of the day, that's what you are receiving as a shareholder for X amount of shares. You need to look at those per share metrics. So even if the top line is growing, their energy production is growing, if that per share metric isn't going up, you're not really receiving anything more despite those top lines going up.
No, absolutely.
For sure. All right. Well, let's move on to our final Your Stock, our take company, D2L, symbol DTOL on the TSX. And Brett is going to answer on that company.
So D2L Inc. or DTOL on the TSX, they're a provider of online education through a single cloud platform. The company serves over 18 million K-12 higher education and corporate education users across North America, Europe, and Australia. The stock is currently trading at $12.75 a share, up 19% over the year to date, and has a market cap of $345 million. However, the stock is trading quite a bit lower than its 2021 high, which was just over $17 right after its IPO. During that time, we just saw frothy valuations, however, especially with anything to do with remote work online. So even in the education thing, we saw online courses, they really had that premium valuation at the time because everyone was just pushing into those COVID really beneficiary stocks. And so the stock fell to really the low of $5 range by late 2022, which that really you saw across the industry, especially with those frothy valuations. That's not really unexpected. Like at that time, we would just consider it purely overvalued, especially given the weaker financials relative to what they are now. So really now we need to analyze, does the company now have merit to it, or was it just like many of the other companies that just got lucky with its valuation in 2021? Or is there actually something more to it? Looking at a high level first, we can actually see revenue has grown relatively consistently on a quarterly basis since the IPO, as well general trend towards profitability over time. Now looking at the most recent quarter, fiscal Q2 2025 in US dollars, total revenue increased 11% year over year to $49.2 million. Subscription and support revenue increased 12% to $44 million. Resulting in annual recurring revenue. So that's really that go forward kind of revenue basis, which you can see if you're looking ahead versus looking behind, is $198.3 million. Adjusted EBITDA increased $4.2 million from a loss of $500,000. GAAP earnings improved to a loss of $0.3 million, effectively break even from a loss of $4.8 million. And that's really been the trend for GAAP earnings. It's been either slightly above or slightly below the break-even point for the past couple of years at this point, or I think it's about 6 quarters, I should say. As well, the company is now guiding for fiscal 2025 revenues and support revenue growth of 178 million to 181 million, implying 11% growth from the midpoint. Total revenue of 199 million to 202 million, 10% implied growth, and is guiding adjusted EBITDA of 22 to 24 million, implying 11% growth. Shifting to the balance sheet, it is strong, holding 98 million in cash with only debt, if you consider it, is being leases of 12.5 million. So the cash balance, however, is largely due to that significant capital raised during its IPO at just too high valuations. Although the company has bought back some shares, offsetting those large issuances over time, they've also had quite a bit of share compensation. So it's a bit of a back and forth as far as that goes. But the point is the cash balance, at least initially, was really driven by that share issuance. I will note, however, like many subscription services, the cash is actually paid up front, resulting in a large deferred or unearned revenue liability, depending on the balance sheet. In D2L's case, they have deferred revenue of 113 million. In a growing business, this means cash flows will actually generally look better than the income statement, versus the other way is normally the reverse. In a normal like manufacturing business, you'll see actually the costs are up front, versus this is the revenue up front. So often you'll have a bit of a better looking cash flow statement compared to income statement, and that's no different here. Operating cash flow for 6 months came in at 16.6 million, but had an increase of 19.1 million due to deferred revenue, ultimately really being the cause of that positive cash flow. If you look at the reconciliation to net income for the 6 months, it was a positive 0.3 million, and that's really the big driver, as well as there's some stock compensation in there as well. And that's not to say receiving cash up front is bad. It's overall really a good thing. That's a beneficial thing to have as a business, to receive your cash up front. But it is really a factor you should be aware of when looking at financials, especially when you do see they're quoting they have free cash flow positive and it's growing at a great rate. You need to realize they haven't really accrued those costs yet to earn that revenue. And that's why it's not recognized by accounting principles or GAAP net income. So shifting to valuations, however, the company is currently trading at 1.3 times guided fiscal 2025 sales, which I think, given their recurring revenue, their guidance is quite tight range as well. That's a reasonable forward-looking metric. And as well, it is 7.3 times forward EV/EBITDA, which does have a bit more wiggle room, because obviously you're not just looking revenue, you're looking at all the cost basis for EBITDA. So it has a bit more of a wider range compared to their revenue. Overall, I would really say for D2L, there's not really any massive red flags. We're not coming into this company where you see massive debt position, no growth, something like that. They have a strong balance sheet, they have growth over time, and at this time they have a really reasonable valuation. However, the company is still really at the break-even point for GAAP earnings, given the front-loaded cash scenario. If the company is really able to push into those GAAP earnings, it gives a bit more weight as it accounts for things like stock compensation, and it attempts to properly match revenues and costs at the point of accrual accounting. So we really want to see that, because that really shows it's a bit more of a sustainable business. They didn't just receive this front-loaded cash and then throughout the rest of the year they're just whittle away the cash, and then they have another prop up next year, and it goes like that over and over again. You'll see that in the odd business that has this cash up front. So that's really something you do want to see. It's either more recurring revenue, of course, but it appear to really be throughout the year, and that's what happens in the accounting earnings, the way it's treated. As well, a couple of things that I really be looking for in this company is how it spends its cash, as it is open to M&A. Even though I didn't really go into it, they have acquired and have divested during the last year. So really a better picture of long-term M&A is a question we really pose to management, as well as their strategy about acquiring market share, because the education technology market is quite competitive. There's many even public market players. There's plenty private market players. And that's really, you want to see how they compete, how their products line up, where they're looking to grow. Just going through the conference call, they're really looking internationally. Initially, they were primarily a Canadian company, but they're actually having a larger share of their revenue coming internationally now. And that's something which I expect them to go forward through in the future. But that's something we'd also want to ask management about, because sometimes you will have them have a complete shift and that was opportunistic, but I don't believe that's the case, but it is always something you want to ask about. So to close off before the guys give their thoughts, the company really is interesting. It passes that initial sniff test. There's no major red flags. It doesn't have some absurdly low valuation at this time either, though. So it's not you need to jump on it this minute. It's a company that we will continue to monitor, as well as delve deeper into the strategy, likely with call with management, as well as look into the further details and see if it can develop any gap profitability or if any other issues arise, look into their M&A strategy and so on.
Yeah, that makes sense. Aaron, I think you're muted. Where are you going? Anyways, no, it makes sense. I think the other thing is, I mean, it's about 10-12% growth in revenues. I think, having a little bit higher revenue growth would, make it a little bit, more sexy for the market if we had it at a higher level. And then a breakthrough into gap profitability, although the free cash flow does look relatively good. It's decent. So, I mean, there are some things to pursue. We may end up booking a call again with management here.
No, certainly. And I mean, of course, with these technology companies, another thing to concern ourselves with that Brett had mentioned as well was just that share-based compensation.
Yeah.
It's this is subject to wide debate because share-based compensation is a means of paying your employees, but it's not accounted for in the free cash flow. So that is one of the things that weighs down on the profitability. Now, in terms of just analyzing whether or not that's a reasonable amount of share-based compensation, that's just another area of the research that we would conduct. But certainly it passes the initial criteria with the free cash flow.
Yeah, on the share-based compensation, I think the last couple of years they've done about 5 million. So it's not one of those tech companies which is 20, 30, 40% of their revenues, which you will see.
Revenue, yeah.
That's not
yeah.
some absurd not occurring. It's a realistic thing that has happened, and we have seen that, and then they just dismiss it and ignore it in adjusted EBITDA, which you will see time to time. Especially, I will say, when companies are buying back shares like D2O has, is you're really shifting from left hand to right hand. You're issuing shares to your employees or senior management, most likely, and then you're buying back shares in the market. It should really, at that point, in my opinion, just be an expense, because it's if they issue to the share, if you did it in the reverse, you issued shares to the market, raised capital, and just paid your employees in cash, it would be a normal expense at that point.
Mm-hmm.
Yeah. All right. I guess that ends off our show for this week. Brennan will be back. Moose pending, bear fight pending, or whatever he's doing right now. We should see him back. He actually, during just a couple seconds ago, called me. So I think either he's asking for help with the bear or the moose, or he's coming back and should be back next week. But we will be in Toronto. So if you are in the Toronto area, Friday and Saturday of this week, we'll be there speaking at the Money Show. And Brett will kind of put some links to register for that below. Again, I'd like to wish everybody first we want to tell you to subscribe. If you're on YouTube viewing this right now, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thank you.